Okay, so
Okay, guys. Well, as you know, we've been kind of looking at some portfolio optimization and what we can do to save for retirement. And that led us down a very interesting path where I came across Gary's blog and has read his book. He's the author of Dual Momentum Investing, an innovative strategy for higher returns with lower risk. I think it's a fantastic strategy. And I'm really excited about his presentation tonight. So Gary, tell us a little about yourself and how you got started.
Well, thank you. I'd be happy to fill you in on how I got to be doing these weird and wonderful things that I do now. When I got out of college in 1974, I went to work for Merrill Lynch. I moved over to Smith Barney, which was a institutional investment banking firm then. And they just merged with Harris Upham in order to get some retail participation. And they got rid of most of the Harris Upham staff, other than a few people. And one of the ones that held on to was a over-the-counter trader, market maker named Bob Topol. And Bob was like a legend in the business. Back then, the OTC market was not like it is today. The individual market makers maintained markets in all these different securities. So he came to our office one day and told us what he did, and we were impressed and told him so. And then he, as an aside almost, as he was finishing up, he said, well, thank you, but there's someone who does a lot better job than I do, that I know. In fact, this person is the best investor that I'm aware of. Would you like to hear about this person? And of course we said yes. So he said, the person who is the best trader I know of is my wife, Dorothy. And we were kind of puzzled by that. So he said, do you want to hear what she did and what she does? And we all sat back down and said, sure. So he said that Dorothy was patriotic. And so years ago, she bought all the companies that had American in their name and all the companies that had U.S. in their name. Can you hear me okay? Hello? I'm getting some negative feedback here. Can you all hear me?
Yeah, we can hear you just fine. Please continue.
Okay. Yeah. Okay. So she bought companies like American Cyanamid, American Brands, American Motors, American Home Products, American Airlines, American Telephone, Steel, U.S. Gibson, U.S. Shoe, etc. And she did really, really well. So after a few years, she decided to diversify, and she bought all the generals. General Motors, General Electric, General Dynamics, General Telephone, Media General, etc. And we all had a good laugh and went out to lunch, but I couldn't help thinking about it and wondering, how is it that his wife did better than all these professional money managers that Bob dealt with all the time? And it occurred to me that it was because she didn't have any transaction costs to pay, and transaction costs were quite high back then. She also didn't have any management fees, and she had a really well-balanced portfolio. Back then, most people had a bias type portfolio. If you were an aggressive investor, you bought the Nifty 50, Glamour, growth stocks. If you're conservative, you might buy defensive stocks like utilities. And instead, she had small caps, large caps, value growth, whatever. And so, in effect, she had created the world's first index fund. And she beat everybody that Bob knew. So after thinking about this a while, I decided I was going to leave the investment business. I needed to know more about how the markets function. And I applied to PhD programs at Chicago, Wharton, and got in. But I thought I would have some problems there because I couldn't get my head around efficient markets. So I went to the Harvard Business School. And while I was there, I managed money part-time for students, their families, and even some of my professors, and continued ever since then with doing research and managing money privately. I've never had to work for anyone since then. In the 1990s, I came to a revelation that I wasn't going to be the best trader in the world, so I wanted to find who they were and see if I could work with them. And I was one of the first people to find and identify traders like Paul Tudor Jones, Richard Dennis, Louis Bacon, Monroe Trout, and others. And I used modern portfolio theory principles to put together hedge funds using all of them, and did very well. I was able to semi-retire after 10 years and did some other things. But I always kept an eye on what was going on in the markets and in the research side of things because I needed to manage my own resources. I didn't think I'd ever find anything as good as what I had been doing. But lo and behold, about 10 years ago, I did a study of momentum. And I found that there was enormous potential there that wasn't being exploited very well. And I figured, well, maybe there's a better way to do this. So I did my own research. And I wrote a couple of research papers that won awards. And I wrote a book, Dual Momentum Investing. And I developed some proprietary models that are used by a number of investment advisors now. So before we go into that, we need to understand what momentum is. So who can tell us that?
Okay, do you want some member of the audience here to answer?
Sure, anybody.
Okay, who wants to give a definition or a tentative definition or proposed definition of momentum? I mean, I know what the answer is. Oh, hang on, we got Michael here. Michael?
He did it. When an object moves, it continues to move in the same direction.
Yes, that's the classical definition. That's what Newton discovered. When I was in Texas, I asked that question, and somebody said, well, it means you ought to ride a horse in the direction he's still headed. You know, but Newton had it right. A body in motion tends to stay in motion. Now that applies not just to the physical universe, but to the financial world as well. And Newton decided to put that idea into practice. And at that time, what everybody wanted to own was South Sea stock. It was the Bitcoin of the day. So Newton invested a bit, and he did very well, took his profits. And then he saw all his friends and neighbors getting rich beyond the dreams of avarice. So Newton jumped in with pretty much everything he had and did quite well for a while until he didn't. And at first he thought, well, the markets will come back. And then he hoped it would come back. He prayed it would come back, and when it didn't, he had lost everything he had, the equivalent of $65 million in today's terms. Does this pattern of investing look familiar to anyone besides me? Who remembers Newton's third law of motion? We covered the first law already. The third law is for every action, there is an equal and opposite reaction, right? Now, Newton thought of that after this experience. I don't think that was a coincidence. So the person who figured out what to do about it was a classical economist named David Ricardo, who said, cut your losses short, let your profits run on. You've probably heard this before. I don't know if you realize it was written in the 1800s, and that David Ricardo put it into practice with his own investing and retired at the age of 42 with the equivalent of $65 million in today's terms. This is the basis of momentum investing: to cut your losses short and let your profits run on. Now, if you're like Ricardo, or you're like Jesse Livermore or some of these other great traders who can trade on a discretionary basis, keeping these principles in mind, that's fine. But most of us are not like that. We need a rules-based approach, something that can be back-tested and validated, that we can have confidence in and follow. Keep our emotions out of it. Fortunately for us, research was done on this momentum principle back in 1937 by two economists, Cowles and Jones. What they did was look at the performance of every New York Stock Exchange stock from 1920 through 1935. And what they discovered was stocks that did well in one year tended to continue doing well the next year. This is momentum as it's practiced today. Stocks having a 12-month or 1-year look back that have done well continue to do well going forward. This was a revolutionary idea. However, it gained no traction at all because financial economists had physics envy. They wanted finance to be more like a science. So while they recognized that stocks drifted upwards over time, they thought otherwise stocks fluctuated randomly. The random walk hypothesis, which soon evolved into the efficient market hypothesis. Who's familiar with this and can tell us what this is all about?
I'll do it if nobody else wants to. It'd be much better if somebody else wants to take a stab at it. Well, the random market, I mean, there's various levels of random market theory and random market hypothesis, but it has to do with the fact that the assumption is that the market will instantaneously reflect all available knowledge, and so there's no,
right.
It is so-called efficient in doing that, and so there's no anomalies or inefficiencies to exploit.
Yes, that's exactly right. Because people are rational, that's an important assumption. If there were any abnormal profits to be had, everyone would jump all over them. They'd soon be arbitraged away. So the only thing that really makes sense is to buy the market. Burton Malkiel famously once said, professional money managers don't do any better than a blindfolded monkey throwing darts at the Wall Street Journal. Now, I don't think that's a fair statement. Why would you want to blindfold the monkey? He does just as well with or without the blindfold. Nevertheless, efficient market hypothesis grabbed hold of academic finance for the next 30 or 40 years. It wasn't until the late 1970s that academics began to see the light. And what brought that about? Well, first was the advent of behavioral finance in the late 1970s. Two psychologists, Tversky and Kahneman, published some papers in a book in which they showed people could be consistently irrational and can stay that way. And that's not just a few people, not just my ex-wife, it's everyone. The next principle was one of mean reversion, where researchers found that stocks on a short-term basis of 1 month or less tend to be reactionary. They tend to, if they get overextended, then go back the other way. The same on a long term basis of 3 to 5 years. They also found value and size were factors that you might not want to ignore. In other words, maybe you should look at something in addition to just the market itself. And finally, there's the concept of limits to arbitrage. That means that some of these abnormal profits might not be arbitraged away because of career risk, especially by professional money managers. If you're wrong and everybody else is wrong, you keep your job. But if you try to do something different and you're wrong, you get fired. So once people accepted this new information, they were ready to take a look at something like momentum in a serious way. The seminal study on it occurred in 1993 by Jagadish and Titman. They used US stock market data from 1962 to 1989, and they segmented the market into deciles. So from the strongest 10% to the weakest 10%, and they compared their performance, ranking stocks by 3 to 12 month performance. In other words, they looked at stocks that had been strongest over the past 3 months, 6 months, 9 months, or 12 months, and they saw how they performed over the following 3, 6, 9, and 12 months. And what they discovered was the same thing Cowles and Jones had discovered in 1937. Momentum works well. Now, academics weren't willing to just accept this one study. So they got busy and they looked at momentum all different ways on different asset classes over different time frames. And what they discovered over the next 20 years is that momentum works well, not just with stocks, but with stock indices, sectors, bonds, commodities, currencies, pretty much everything, all the way from the 1800s until now. In addition, academics want to understand why something works. But let's take a look at by asset class first. This is the green line is US stocks. And we see how consistently momentum applied to US stocks has been since the year 1800. But that's not even the best performing asset class. Currency asset class here is a combination of all of these. Currencies is here. And what they call equity here are geographically diversified stock indices. In other words, something like the S&P 500 for the US or the FTSE for the UK, etc. Momentum works because of underreaction and overreaction. Initially, when information comes into the marketplace, it's not acted upon immediately. There's a lag. But eventually, information has to catch up with what's going on, and what's going on has to catch up with the information. So there's a trend which leads to an overreaction. So we have initial underreaction caused by anchoring or conservatism. People are just reluctant to make changes. There's a slow diffusion of information throughout the marketplace. It just doesn't get accepted right away, not by everyone. There's what's called the disposition effect. That's a behavioral tendency to take our profits too quickly and to hold on to our losses too long. Everybody has that psychological tendency. If you examine your own investing, you'll see that you have those inclinations too. And this creates a headwind that keeps assets from going to their true value right away. But eventually, they have to reach their true value in kind of a dynamic way. And then we have overreaction because of herding. People just want to follow the crowd. They want to follow the trends when they occur. There's also recency bias or representativeness. When we see something moving, we assume that it's going to keep moving, and we try to go with it. And that leads to confidence and then overconfidence and overextension of these trends. So what have we seen with respect so far to systematic momentum? Well, there are high and consistent returns, it's persistent over time, it works well with all assets, and there are good explanations for it. This led Fama and French, two of the pillars of the efficient markets, to declare that momentum is the premier market anomaly, one that's pervasive and above reproach. So we see stock momentum is persistent, pervasive, robust, intuitive, but the final question is it investable? So let's take a look at what happens when we're dealing with momentum applied to individual stocks. Let's start with a 500 stock universe, like we have over here. And if we look long term, we see the return is about almost 10% a year. Now, this is a momentum portfolio. Stocks picked on the basis of 12-month momentum, their performance over the past 12 months, rebalanced every month. So we see as we become more selective, the returns get higher and higher. And momentum returns are also a function of how often we rebalance. So if we don't rebalance very frequently, we don't get nearly the return as if we do monthly rebalancing. Now, what do you think is going to happen if everybody starts to follow momentum and do their rebalancing on a regular basis, very frequently? Momentum stocks are no secret anymore. Alpha Architect puts the top 100 momentum stocks up on their website every month. Anybody can go and find out what they are. Momentum stocks tend to be more volatile than other stocks. They have wider bid-ask spreads, so their trading costs and trading frictions are higher. So you might turn over 25% of your portfolio every time you do a rebalance. What do you think is going to happen if you have a lot of people and an enormous amount of capital all trying to get in and out of the same volatile stocks on a frequent basis? You're going to have some problems, aren't you? You're going to have some transaction costs. We're not talking commissions here. We're talking the costs of entering and exiting these stocks in terms of bid-ask spreads and liquidity. It's kind of like 100 people trying to go through a doorway at the same time. So academics realized this could be a potential problem, and they started to look at it in a way that they thought might make some sense. The first study that appeared in the Journal of Finance by Lesman, Schill, and Zhao concluded the abnormal returns associated with these trading strategies, which they meant stock momentum trading, creates an illusion of profit opportunities when in fact none exist. A couple of years later, Karashchik and Sadka tried to estimate what the capacity was. They said as much as $5 billion may be invested in momentum-based strategies before the opportunity profit vanishes. There's much more than $5 billion invested in stock momentum now. Now, when practitioners, fund sponsors in particular, saw these studies, they weren't very happy about it. So they did what drug companies do sometimes, what food companies do, what the tobacco industry did. They hired their own scientists, or they used their own scientists to do their own studies. And they came to somewhat different conclusions. Frazini, Israel, and Moskowitz in 2014 took their database that they use with the company they work for called AQR, and they concluded that with sensible trading strategies, if you manage, how you put your orders in and out, they conclude the main anomalies to standard asset pricing models are robust, implementable, and sizable. Now, they included all different factors in here, not just momentum. And other factors have much slower turnover. So even though there were some people saying, hey, this shows that momentum is fine, we shouldn't worry about it, the study I don't think is all that relevant. Now they did do a later study using 7 years of momentum-only trading. However, their idea of momentum trading is a bit different than other people's ideas. They use for example, on their large cap stock momentum fund, they have a universe of 1,000 stocks, and they'll be in almost 500 of those stocks at any one time with their momentum fund. So it's not really a focused type momentum portfolio. Now the guys at BlackRock, who also run a momentum ETF, also did a study, and they said for a one-day trading horizon, momentum is a strategy with the smallest asset under management capacity, but they said it was up at $65 billion, quite a bit. However, they also said their results are based on unrealistic assumptions. At least they were honest about that. Actually, most of these results are based on unrealistic assumptions because nobody really knows what's going to happen in the marketplace using this type of trading. So what others have tried to do is actually look at theoretical versus actual. And the first people to do this were those at research affiliates. And they came up with kind of a clever way of doing a multiple type 2-stage regression, where they first identified what the momentum weightings were on all the funds out there. And then they ascertained with the second regression just how well the actual returns matched up with the theoretical. And they found a large fall off. The theoretical factor returns from funds out there from 1991 through 2016 was 5.7%. But the actual returns captured by managers was only 0.4%, for a really large shortfall. Now, there were some problems with their study. It wasn't entirely accurate. So Patton and Weller at Duke did an improved version of it to overcome some of the difficulties there. And they also did a pairs trading analysis, so a second type of study of the same. And they concluded our estimates imply implementation costs erode almost the entirety of the return to value and momentum strategies. We agree with Lesman, Schill, and Zhao's 2004 analysis that momentum profits in particular may be out of reach for the typical asset manager. And yet you see a lot of momentum funds out there, and other ones being formed all the time. Let's take a look at a couple of those funds. Here's the two that have been around the longest. The first is the PowerShares DWA Momentum ETF, managed by Dorsey Wright. It's earned 8.6% from inception in 2007, April 2007 through 2018. The benchmark it uses was up 11%, shortfall of over 2% a year. The AQR Large Cap Mutual Fund began in the summer of 2009, returned 13.2%, started at a better time. The Russell 1000 Growth Index, their benchmark, returned 15.2% for a shortfall of 2%. Academics have also looked at momentum more recently in terms of going back further in time. And what they've concluded in these two studies is that momentum profits have slowly disappeared since the early 1990s, and momentum profits have become insignificant since the late 1990s. And this is before transaction costs, before trading frictions are even considered. So how many of you still want to go out and do stock momentum? Maybe not so many now. Well, how about some of these other factors? Factor investing has become very popular. We hear about it all the time. Conferences are being run by Morningstar, by others, in which they feature factor type investing. Here's some of the more common ones. In addition to momentum, you have value, quality, low volatility, and size. Bloomberg has tracked the assets under management for factor type ETFs. We can see enormous growth, and BlackRock is projecting that there'll be over $2 trillion invested in factor type funds in just a few years. And why is that? Well, a lot of people know now that active investing is problematic. There have been a number of studies showing that passive investing generally beats active investing. But how are money managers going to be able to make a living? Just by putting people in the S&P 500 or in a balanced stock bond index fund. They're not. So they need something that offers people the potential for a higher return. And they point to some of the early academic studies to show that there's a premium associated with various factors. So let's take a look at the most common ones. Small cap stock investing has been around probably the longest. Does size really matter? Well, let's take a look at the Russell 2000, which is a small cap index, versus the S&P 500. Back in the late 1970s, Bonds from the University of Chicago published a report in which he showed there was a small cap premium. This index of the Russell 2000 was actually started before Bonds' report. And we can see the compound annual growth rate of the Russell 2000 has been 11.3%, while the S&P 500 has returned 11.6%. The standard deviation has been considerably higher for the small cap stocks. There was a study done in which they looked at the Sharpe ratios of small cap versus large cap stocks throughout the world. And they found that there was no significant difference throughout the world or in the US, all the way from 1926 through 2014. So you might be thinking, well, how can this be when Bonds' study showed that there was? Well, when he did his study, they weren't adjusting for survivorship bias in the CRISP database that he was using. So once you adjust for that, there really is no small cap premium. And yet people continue to invest in small cap stocks. What we know about them now is that there was an upward bias due to errors on delisted stocks. Transaction costs offset much of the premium, if there ever was one. The anomaly no longer exists inside the US and never existed outside the US. Let's take a look at value. This is a very popular factor, and it appeals intuitively to people. We all like to go to the store and get a bargain, right? Now, the reason stores will have things on sale is because they want to move some slow-moving inventory, or they want to bring you into the store so you'll buy other things. Well, Mr. Market doesn't care about those things. Market's not going to give you something for nothing. And Israel and Moskowitz, who work for AQR, which is a firm that uses factors, they said in 2012, the value premium decreases with firm size and is weak among the largest stocks. And then following it up a few years later, the AQR guy said the market adjusted return to value within large cap is not reliably different from zero. This is the way value is mostly used. There are hundreds of value funds out there, mutual funds and ETFs, and most of them are large cap value funds, where the return, risk adjusted, is not reliably different from zero. Where you might find some value premium is in microcaps, and those are extremely difficult to trade and very expensive to trade. Here's a chart showing that microcap spreads can be 100 times more than the spreads on an S&P stock or ETF. You go from 0.8 for popular ETF up to 8% on the spreads for microcaps. Here's a study of value versus growth that a friend just put together, comparing performance of the Russell 3000 growth versus the Russell 3000 value, annualized. The difference in their return from inception almost is time frames from 1 month up to 30 years. And we see there's practically no difference between value and growth over that 30-year time span. Here's a very interesting study that was done in 2006 by Loughran and Howe. You don't see this anywhere floating around the internet, except on my blog. People don't really want to acknowledge it. But what they did was they took every mutual fund from 1965 through 2001, and they put it into categories based on price to book, which is a standard way of identifying value or growth. And those with the highest price to book were growth stocks. So the top 25% were called growth. Bottom 25, price to book or book to market, were value funds. And then the middle 50%, they called neutral, and they just ignored them. So they compared the return of value minus growth on large cap stock funds, 1965 through 2001. And they found that value outperformed growth by 0.11% per year, which is insignificant. It means nothing at all. T-stat is basically zero. Now, where they thought they would find some value premium was in the small stock area, small cap stock. So they looked at value versus growth there, and they were really surprised to see that growth actually outperformed value by 0.42% per year. And they concluded this was for the same reasons we saw with respect to momentum, that trading frictions and transaction costs made it very difficult and expensive for small cap stocks. Let's go back to Patton and Weller with their study, where they looked at actual funds. And remember, they said our estimates imply that implementation costs erode almost entirely the return to value and momentum strategies. So it's not just momentum, it's value too. So what can we say with respect to the value premium? This area has been overinvested. It has high tracking error. You can go 10 or more years with value underperforming the market. And we've been doing that recently. It's mostly, if there is any premium, with small and micro caps, which are very difficult and impractical to trade. And in practice, value is underperformed. Now I go into this in more detail, as well as look at a couple other factors on my blog post called Factor or Unicorn Ranch. So if you go to my blog, you can see it. Where's the factor alpha? Here's a study by Blitz in which they looked at smart beta ETFs. And they looked at the alpha, or which risk-adjusted type real benefit you get. And they found it was minus 0.3. About the same, in fact, a little bit lower than conventional ETFs. Really wasn't anything there. Or harvesting factor premium. So we may not look to factor investing as a panacea. Sponsors want us to think it is. Two. Before we're going into that, I want to make sure everyone's following me so far. So, but let me tell you the story first about John. John graduated with a degree in computer science from UNC and got a job in the Research Triangle and was doing well. And one day he called in to his boss and said, "Hey, boss, I got to get my body hurts. I'm going to stay home today." And his boss said, "John, we're behind schedule. We really need you here. When I'm feeling like you do, I feel better. I go to work. I suggest you do the same." So an hour later, John calls up his employer and says, "Hey, boss, what you said. I feel much better. I'll be coming to work now. You have a really nice house." So the point of this is, people here.
Gary, we're having a little bit of trouble hearing you.
Is your, could you reinitialize the audio connection? I don't know what type it is.
Yeah.
You were just breaking up for a little bit. That's all.
Okay, you didn't. All right, let me see what I can do here. Audio.
It sounds a little bit better. Maybe it's your reception, or if you're on a wireless.
Can you hear me? Yeah, I'm on. Actually, my phone I thought would be better, so I'm using that.
Yeah, I think we're just.
Can you hear me?
We can hear you just fine now. I think we're just losing a little bit of reception, but it seems to be a little bit better now. Thank you.
Okay. So you missed my joke then.
Unfortunately, we did.
Okay. All right. Well, what I wanted to say was I want to make sure I'm not haven't lost anybody too much so far. So if anybody has any questions up to this point, I'd be happy to take them.
Great. Let's look around. And by the way, we have about over 20 people online and another 22 or 23 here in the room. So we have a good turnout. Now, who has some questions? I guess let me ask one. You showed a lot. You're showing the factors and so forth, and the theme here is, if I'm not mistaken, that these are misguided or they're not taking us anywhere. Is that right?
That's what the data shows. If you won't see that out on the internet much, but if anybody wants to bother, to research it themselves, that's what they'll discover.
And also earlier you showed a whole bunch of criticisms of momentum, but I think what you're going to conclude in the end, just so people don't lose all hope, is that it works just fine if done right. Is that correct?
That's correct. That was the point I made in the beginning, is that I did some research 10 years ago, and I saw enormous potential with momentum, but that it wasn't being used as well as it could be in the marketplace. So I set about to set that right.
Yeah, I have the badge of having read your book, so I'm maybe peeking ahead a little bit here.
Okay.
Does anyone online have any questions? We can bring up your mic too, out on the web. Ryan, do you see anything there that anybody has any indicating they have any questions? feel free.
You can
Type-
just, you can read it to me if somebody has.
Okay, none right now, Gary, thank you.
Okay. All right, well, let's proceed then. Okay, remember I said that momentum does best when you're looking at geographically diversified stock indices. That's what Getsky and Samanov showed in their paper in 2015. Well, I had discovered the first thing, the same thing in my first paper, which I wrote in 2011, in which I looked at momentum with respect to individual stocks, industries, styles, and geographic diversification. And I found the same thing, that it works best when you look at it geographically. So then how might you do that? Well, one way is to go into the 47 or 48 different countries, but you'd end up with kind of a mess because a lot of them are very volatile, some of them are not very liquid, and if you leave some out, then you get into some selection bias as to which ones you're going to include and not include. So fortunately, there's an easy way to do this, and that's looking at an aggregation of them. And about half the world capitalization is in US stocks, and the other half is in the rest of the world. So let's split things up that way. And fortunately, there are ETFs that do just that. So for US stocks, we'll use the S&P 500 index. And for non-US stocks, we'll use the MSCI All Country World Index ex-US. That is cap weighted, includes developed and emerging markets. And there's there are several ETFs for that as well. These are highly liquid ETFs, just like the S&P 500. And what we'll do is we'll use a 12-month look back. That means whichever of these has been stronger during the preceding 12 months is the one we're going to invest in. And we'll reevaluate that on a monthly basis. So if the S&P 500 has been strongest during the last year, we'll invest in it. And then we'll look again the following month. If it continues to be stronger than the world index, we'll keep holding it. If the world index is stronger, then we'll hop on over to it. It's kind of like being on a train. And when a faster moving train comes alongside, we hop on over to it. And then if it slows down and another train comes alongside, we'll hop onto it. So we're always staying on whatever has the best relative performance. And let's see how that's done. Okay, this starts in 1950. The line here is the brown line you see is the S&P 500 index, performance of it. The purple line is the MSCI All Country World Index. And then the green line is the strategy I just outlined, of relative momentum, where we go from whichever has been stronger over the preceding 12 months. Now, there's no problem with transaction costs here. There's fewer than one switch a year, and these are both highly liquid ETFs that we can easily get in and out of in size. So what kind of results have we gotten from this strategy? Well, this simple strategy of switching between US and non-US stocks based on relative momentum earns 210 basis points more a year than the S&P 500 index. So you make more than 2% a year than you would have made in the S&P 500 just by doing this simple switch. So for a buy and hold investor, why would you not want to do this? You don't have really any tracking error because you're always invested in the stock market. And you earn an extra 2+ percentage points a year. It's a no-brainer. And yet, I don't know anybody who's doing this. So why not? Well, there's a home country bias that exists everywhere in the world, where people just prefer to hold on to their own country's securities. So people in the US and institutions or investors using global asset allocations, they wouldn't want to have 100% of their equity in non-US stocks, even if it's just for some of the time. They might have 25 or 30% in non-US stocks. That home country bias creates an opportunity for those of us who can overcome that bias. So what is it what we're doing here? Well, traditionally, we have what I call vertical diversification, where we hold simultaneously a number of assets. So if we were vertically diversifying here, we would have 55% of our assets in the S&P 500 and 45% in the world index. That's the percentage of time that we're in each of these. So if we were diversifying the way most people do, we'd be about 50-50. However, there's another type of diversification, which I call horizontal or temporal diversification, where we diversify with respect to time. See, diversification is important with momentum, just as with everything else, but it's a more intelligent way, a more adaptive way to diversify, so that we're not having our performance affected by whatever assets are lagging. So in this case, 55% of the time, we're entirely invested in the S&P 500, and 45% of the time, we're entirely in the world index. So what this really is a global macro type strategy. The blue line here is the US dollar index, showing the strength of the dollar or weakness of it versus the rest of the world currencies. And the green line is the US to non-US stocks. We can see a pretty high correlation here. So what we really have going on is an adaptation to global economic factors. And those don't change on a dime. You know, they tend to persist over time, which is why this strategy works so well. We can see that here with respect to major US dollar cycles of strength and weakness, and versus the stock indices. So when the dollar was really strong at this period, US stocks outperformed non-US stocks. When the dollar was weak, non-US stocks outperformed. Dollar was strong, US stocks outperformed. Dollar was weak, non-US stocks outperformed. Dollar strong, and US stocks outperformed. Now, is there any drawback to this strategy? Any downside? Well, the downside is where these arrows are. That's the downside. Those are bear markets. This strategy does not avoid bear markets. We see them here and here and here. So it gives us 2% more a year in return, but it doesn't do anything to cushion the downside. Now, why is that a problem? Well, some of you may be familiar with the Dalbar study, in which they look at the performance of mutual fund investors versus the performance of the funds that they've invested in. And they find there's a shortfall. They find about 4% a year shortfall, and other studies have also found shortfalls because people don't tend to invest objectively. They get swept up by their emotions, and they tend to buy when they should sell and sell when they should be buying because of fear or greed. Craig Fisher said, we don't have people with investment problems, we have investments with people problems. So what can you do about this? I mean, stocks are very volatile. You know, it's understandable that people would have their emotions caught up in them because of the high volatility. So how do most people deal with this? What do they do so that they can behave somewhat rationally and sanely? Well, they diversify, right? Is that what people do generally? And what do they tend to diversify in? Someone tell me, so I know that you can still hear me.
U.S. markets.
Yes, we're in U.S. markets, but if you don't want to be entirely in U.S. in stocks, what would you tend to invest in to reduce the volatility of your bonds? Yes, bonds. That's correct. Here they are, bonds. You're the best ones right here. Now, there's some issues associated with bonds. First of all is the return. Now, recently, bonds have been doing pretty well. You know, they actually outperformed stocks during this period. But if you look longer term, stocks have done, in terms of real return, about twice the return of bonds, and almost 3 times, or over 3 times the return of real return of bonds, looking over a further period going back. Stocks and bonds are also not always uncorrelated. They have been recently. The blue line down here means it's a negative correlation. But we can see this bounces around considerably over time. Sometimes stocks and bonds move together. So you're not really diversifying as much as you might think you are if you take your data back far enough. Stocks and bonds have similar risks, actually. We can see here recently, stocks have shown much greater downside volatility, but as you go back further in time, bonds have been just as volatile as stocks. In fact, the worst real return drawdown since 1900 for stocks has been 73%, and for bonds it's been 68%. Since 1807, the worst rolling 10-year return has actually been worse for bonds than for stocks. So when is a good time to invest in bonds? The slide should give you a hint.
Bear markets.
Yeah, the best time to be in bonds is when stocks are going down. And why is that? Well, one reason is the flow of capital. People will want to put their money into bonds rather than stocks when we're in a bear market, stocks. The other thing is stock market is a leading indicator. So the Fed sees stocks going down. You know, they see a recession coming. They want to stimulate the economy and they want to keep interest rates low, which is also positive for the bond market. So we see really good consistency here in terms of returns for intermediate term bonds during bear markets. So all you really have to do then is contact your financial advisor and have him or her tell you when stocks are going to go down. All you have to do. All right, so I guess I don't have to say anything else. But if you think that might be a problem, then let's take a look at another way of doing it. So far, we've been talking about relative momentum. That's where we compare performance of one asset to other assets, also called cross-sectional momentum. But there's another type of momentum called absolute or time series momentum, where you look at the performance of an asset with respect to itself over time. This is sometimes known as trend following. So if an asset has been going up, we know that momentum means persistence in performance. So it should continue to go up. And it's been going down, it should continue to go down. So why don't we put together a strategy using absolute momentum? And what we'll do is we'll switch between stocks and bonds, depending on whether stocks have gone up or down over the past year. We'll use the same 12-month look back that we used before, and we'll rebalance monthly. So if the S&P 500 has gone up over the past year, we'll stay in the S&P 500. If it's gone down, we'll switch into the Barclays US Aggregate Bond Index and stay in that until the 12-month performance of the S&P 500 is positive again. And let's take a look at that strategy. So the S&P 500 is again this brown line, and absolute momentum strategy is the yellow line here. And this doesn't have as high a return as we saw before with relative momentum, which made over 2%, 210 basis points more a year than the S&P 500. But absolute momentum has made 90 basis points a year more than the S&P 500 index. In addition, we haven't had to worry about these bear market periods. We've been safely in bonds during those times. We can take it further back in time, all the way back to 1927. We can only go back, 1950 with stocks because that's all the data that's reliable, but well, for international stock. But for the S&P, we can take it back to the 20s. And so we see here absolute momentum, which is the blue line, versus the S&P 500. We can see higher return, higher Sharpe ratio, and less volatility. When we look at the bear markets, we see each of the bear markets since 1929, we see that the absolute momentum has outperformed greatly during all of the bear markets. And if that's not far enough for you for absolute momentum, you can go all the way back to the year 1223. Stocks go back to the 1600s. That was part of this study, but they looked at other assets back to the year 1223, and they found trend following has a higher return, higher Sharpe ratio. So which would you choose, relative momentum or absolute momentum? Well, why not both? And this is the unique contribution I've made to the world of investing. What I do is I look at whether the S&P 500 has been up or down over the past year. If it's been down, then we switch over to the safety of bonds until the S&P 500 has been up over the past year. If the S&P 500 has been up, then we use relative momentum to switch between the S&P 500 and the world index. Again, with monthly rebalancing and a 12-month look back. So let's see how that looks. Well, let's start with the S&P 500 index here. Since 1950, it's earned 11% a year. Now with relative momentum, we see that 210 basis point increase in annual return, but the drawdowns remain high, volatility remains high. When we go to absolute momentum, there's 90 basis point increase in annual return, but volatility goes way down and your drawdown goes way down too. Look what happens with dual momentum. We have 440 basis points more a year in annual return from dual momentum. Very high Sharpe ratio, and our drawdown is under 20%. Because there's a synergy here. What happens if you have a 50% loss? How much of a gain do you need to make up that loss? You need 100%, right? So what if you could avoid that 50% loss? Well, then any profits that you have when the new bull market starts, that goes right to your bottom line. You're not making up losses. And that's how you get the synergy here. Here's a rolling drawdown. So you can see the S&P 500, and here's global equity momentum. Much gentler ride. Let's look at bear markets. What happens? If we used only relative momentum, we would suffer almost as much on the downside as we would with the S&P 500. But because we have absolute momentum to protect us, we've actually turned these bear market losses into small profits in aggregate. Not every bear market, but in aggregate. Let's look at bull markets. If we used only absolute momentum, we would underperform in bull markets because absolute momentum doesn't get in or out at tops or bottoms. There's lags. So we miss out on some of that performance. And there are occasional whipsaws along the way. But by including relative momentum in it, in our dual momentum process, we outperform in bull markets as well as bear markets. Pretty neat, huh? Here's a histogram showing rolling 12-month returns. This is the S&P 500 index. You can see the range from minus 45% to about up plus 65%. Here's the range of GEM is global equity momentum. That's what I call this dual momentum model that's written up in my book. We go from about minus 20% to plus 90%. When you superimpose dual momentum over the S&P, you can see we've truncated away much of the left tail of the distribution and extended the right tail. So what are the advantages of dual momentum? We've seen it's been extensively researched all the way back to the 1800s and even further. If you look at just the trend following component, we see high expected returns, low trading costs, low drawdowns, high scalability. I like to say it's like being a sailor. You can't control the wind, but you can get in tune with it and adapt to it and let it take you where you want to go. When I showed this one time to a professional money manager, he said, well, why isn't everyone doing this? And I've wondered that at times myself. One thing is, some people think it's too simple. In fact, if you go to the Amazon page for my book, it's mostly 5-star reviews, but there are a few people who don't get it. And they sometimes say, well, how can something this simple be so good? Well, the reality is, the reason it's so good, one of the reasons is because it's so simple. When you have a lot of moving parts, you have a lot more things that can create issues with overfitting or, creating problems that don't need to be there. Einstein said things must be made as simple as possible, but never simpler. It's also counterintuitive. Remember, I mentioned the disposition effect, where people want to sell something when it has a little bit of a profit or stay away from it. But with momentum, you're doing the opposite. You're going with something that's already gone up. So you have to adjust your way of thinking. Some people have a skepticism toward models. I do too, and deservedly so. Most of the models you see out there are just overfitted, what you might call curve fit. They take a lot of parameters and just fit it to past data, and that almost never works going forward. You want to keep things simple. You want there to be some principles behind it that have make sense and that have been back tested back as far as possible. And with dual momentum, we're getting towards the time of Genesis here. with the testing that's gone down. Some people stay away from markets now because of valuations. And back in 1999, they said the S&P 500 was way overvalued, like it is now. And they were right. Over the next decade, the S&P 500 was down 9%. But look at what dual momentum did. Because it was rotational, it was able to go with stocks when it made sense and switch over to bonds when it didn't make sense. There are behavioral biases that keep people away from something like this. Familiarity bias is one. Not very many people have heard of something like this. Just the concept of momentum is strange enough for many people. There's anchoring or conservatism for something new. Some people have prejudice against the tactical or technical type trading approach. There's a home country bias that we've mentioned before. And some people just have a preference for stocks rather than indices. Why is it important to overcome these biases? This is a study that BlackRock did. I was surprised when I saw it. It's just how much cash different generations have. My baby boomer generation generally is sitting on 60% cash or cash equivalents. Millennials are worse, 70%. Now, how are you going to meet your retirement or investment goals holding this much cash? Look at your annual returns after inflation. This is stocks, bonds, cash. Not going to get you there, is it? Here are some systematic withdrawal rates. This was in one of our blog posts. Someone did a study of this, showing how much can you withdraw from a dual momentum approach like I just showed you today. And they simulated this from 1971 through 2017. And you could safely withdraw, up to 9 or 10% a year. Historically, people have said from a stock bond portfolio, you probably have a limit of about 4% a year as a safe withdrawal rate. That may not even be true now, given the valuation levels that there are in the markets. So are there risks involved? Of course. Anyone tells you they have an investment without risk, you just turn around and walk away. First is tracking error. Nothing outperforms all the time, including dual momentum. We do have periods, so it could be a year or longer, where we will underperform our benchmark. That's to be expected if we have periods where non-US stocks have underperformed US stocks, or where the stock market just keeps going up and we don't have a bear market. You have to keep the big picture in mind. There are occasional whipsaws, like I mentioned, where we'll get out because the market looks like it's turning and heading south, and then we have to get back in again. Again, that's just the cost of business for getting the types of returns we've seen here and reduction of bear market volatility. Speaking of volatility, we're in the stock market as much as possible. Buy and hold is a great thing, keeps your costs down, you get some proven returns. We just don't want to be there during bear markets. But because we're there during the rest of the time, we still have to bear the short-term volatility of stocks. And you have to be willing to accept that. If not, then you should be doing something else with your assets. So what are the keys to success with dual momentum or any type of investing? First is patience. You have to give it time to work, full market cycle at least, before you make any kind of assessment of what's going on. You have to have discipline to stay with the model. Investing can be simple, but not always easy because of people's emotions or restlessness. You need to have confidence. And the way you have confidence, as well as discipline and patience, is through understanding. Now, I've only touched the surface today of momentum and dual momentum. To find out more about it, you could read my blog posts. You could read some of the research papers out there that are referenced in my blog post, and you could read my book. It's gotten a lot of accolades. It's done very well, and it has easy do-it-yourself instructions that will guide you through everything I've shown you here today. It takes about 2 minutes a month to do. You can use a simple online charting site in order to get your signals. I'd like to finish up with some words by Seth Klarman, who said the most important metric is not the returns achieved, but the returns weighted against the risks incurred. Nothing should be more important than the ability to sleep soundly at night. I sleep very soundly at night, and I'm hoping you will too with dual momentum investing. So if you join with me in this, may the momentum be with you. Happy to take any questions anybody has now.
Hey, Gary, thank you for your presentation. It's very interesting. I was curious, have you tested any other U.S. indices like the NASDAQ or something else that might be a little bit more of a momentum-based index instead of the S&P for this strategy?
It works with all of them. Actually, you don't want too much volatility because this is a get-rich-slow program, so it's slow-moving. So if you have too much volatility in your indices, you'll give back more profits than you might want to before you get out. So it actually works best with something like the S&P 500, but it does work with other indices as well.
In a follow-up, have you considered or looked at splitting your risk between a S&P and a Qs or a Russell or something like that to kind of diversify between indices?
The small cap doesn't work that well. The NASDAQ's okay, the Q, something like that. But on my FAQ page on my website, I go into more detail about that. So I encourage you to go to the FAQ page, and it'll give you some links to some blog posts that will describe the testing that I've done on these other things.
Thank you.
You're welcome.
Okay, that's let's now. Oh, hang on. John has a question here, so we'll get to him.
Hey, Gary, thanks so much for the presentation tonight. The question I've got is around, I've seen other strategies and maybe they're completely different, but they're called relative strength. So I'm wondering, is this the same thing, or is the difference here between you're not looking at which of the three is the best, you're looking at one and then one of the two stocks? Maybe I missed that.
Yeah, relative strength is half of this. You know, that's why it's called dual momentum. Relative is half of it. But absolute is the other half, and that's trend following. Now, in the first paper I wrote, I combined them together by including bonds or T-bills and using a relative strength approach that way. But it's better to actually keep them separate so you can understand better what's going on.
Okay, I'll look more into it. Thanks.
Well, thank you, Gary. I think this presentation has been incredibly polished.
Oh, I'm sorry. There's somebody saying something. Oh, Ryan.
I think this is incredibly polished and very well researched. And I absolutely love the simplicity of your system. And you touched on some of the behavioral challenges of momentum investing, such as lack of patience. And you're speaking to a bunch of options traders, so we love complexity.
Okay.
But I think this is fantastic. It's really beautiful in its simplicity. Can you discuss some of the perils of data mining, such as using small amounts of data, model overfitting, and selection bias?
Yeah, they're very pernicious, and you see them all over the place. They're very widespread. So what happens is that, in fact, it happens a lot when people read my book. I had that especially when my book first came out. People would get a hold of maybe a dozen years of ETF data, and they'd say, hey, look what I did. I made something that works better. But you're really just fooling yourself, because the regimes are different. So you can go back 15 years, and then that's going to be considerably different than the 15 years prior to that and the 15 years before that. So if you're trying to fit a model to just 15 years of data, it may or may not, and chances are it won't hold up so well on a longer term basis. That's why I try to have as much data as possible. The other problem is if you try to fit too many parameters, then you're just overfitting in a way that you're actually going to get something that's worse rather than better, because you're just custom fitting to the data. So you want to keep things as simple as possible, but no simpler, as Einstein said. And as far as selection bias, that happens because people either know ahead of time, what the probable outcome might be, and so they kind of pick something where they have some bias to it already. It's not truly, whatever statistics you're looking at really are not valid in that case. So you have to be careful on all of this.
Let's. I wanted to recap, because there's always a risk that some of us don't follow. So, but first, let's make sure we got all the questions for everybody in the room here, and then Ryan is going to lead a discussion in detail into some points that he has to bring up. But have people got the basic idea here? First of all, we have.
Let me add one thing. Let me add one thing too. That can you hear me?
Yes, absolutely.
Okay. When I mentioned how when I was at Harvard I started managing money part-time, that I was doing that by trading options. And when I finished up at the business school, I formed a market maker organization on all 5 stock option exchanges and managed that for a couple of years. So I'm very familiar with that type of trading and that type of mindset. And all of that experience has gone into what I've come up with here. So if anybody, has an option type point of view or wants to ask any questions in that respect, don't feel shy.
Well, let me start that then, since you bring it up. I had on my list to ask anyway, which is seeing as you have, in fact, been in depth into options, and a lot of people in this group are focused on options. Even though it's perhaps off topic, I think, from your main theme, since we've got your expertise here and we appreciate it, what do you think of people who believe that systematic selling of premium is the best route, for example?
Well, that's what put me out of business, actually. I was, I thought I had a well-diversified portfolio, because I was selling combos, puts and calls out of the money on all kinds of stuff. And I had 2 companies taken over the same week. The reason the option prices were inflated, was because of that. So you have to be really careful. The markets are generally efficient, and they'll come and bite you if so you have to be careful when you're trading leveraged instruments, especially.
Do you think it's possible to have a firm or a strategy and make long-term success selling premium?
It depends how you're doing it. If I were going to do it now, I would want to look at implied volatilities and only be a seller of premium when it was really high, because I did it again after that in commodities, and and currencies especially. And sometimes, the premiums will get really inflated. So those are the times when you want to be selling the premium. You don't want to do it when volatility is low. You're asking for trouble then.
Right. Let me just go back once again to try and make sure that everybody's got the basic idea. And let me recap, and Ryan and you can tell me if I'm recapping this wrong. And this is going to recap your thesis, and what it's more than a thesis. You've proved it. You've basically proved, if I'm correct, that you can have vastly superior returns to what the S&P offers, as to what long-term investing offers, and you can have much reduced drawdown by simply buying when the index is up, and getting out otherwise of stocks, and also combining that with what you call, that's absolute momentum. That's all it is.
Correct.
You simply buy if it's up at the end of the year.
Well, not the end of the year. You look every month. You reevaluate monthly.
Okay, so it's on a one-year horizon, but you reevaluate it every month.
Correct.
And combining that then with relative momentum, which simply says buy the stronger rather than the weaker.
Yes.
And so I just want to understand, because to make sure that I got the basic drift. Does everybody understand the basic theme, that's the theme that we have here, and it's fairly extraordinary results? I mean, why isn't everybody doing this? And you'd have far, far, far better results than you're getting by your long-term investment, right?
Yeah,
what's interesting too is that this is 440 basis points more a year just doing this simple approach, and you don't have to do much. I mean, why would you bother struggling with all these other things? How many people do you know who have beaten the market by 4% a year over a long period of time? I don't know anybody.
Now, Gary, in your book on page 98, you talk about using absolute momentum first, followed by relative momentum. However, the decision tree on the following page has relative momentum first and then absolute momentum. Which is correct?
Well, I put it there both ways so people could take their pick. But as I mentioned on the FAQ page, I use the method on page 98. I look at absolute momentum first. The results are a little bit better that way, and I think it's a little more logical, but either one works fine.
Great. And also in your book, you talk about your proprietary global balance momentum. And so how much data was used for that? Bond data.
Bond data, same as stocks. I go back to 1950. But I have proprietary models for global equity momentum as well as global balance momentum. I license those to registered investment advisors, a handful of them who really understand what I'm doing, and they manage their customer accounts this way. It gives little higher returns than what I've shown you here, and a little more consistency for people who want it, and you don't have to do anything yourself because they're managed accounts.
So what research papers did you draw upon to create your variable look-back algorithm that's used in the global balance momentum?
I don't understand your question.
Correct me if I'm wrong, but isn't the globally balanced momentum based upon a variable look-back?
No, none of them are variable. They're all every look back is a fixed amount, but I use multiple look backs.
Okay, multiple then. I gotcha. Depending upon the instrument, that makes sense.
Yeah, and I use different look backs for bonds than I do with stocks because they behave differently.
So, so the complexity, the added complexity does truly add a little bit of value there. That's great. So is this a license that we can purchase and so we can invest our own personal money or family members' money?
No, what you can purchase is my book, and that has instruction on how to do that. If you down, then you can I can put you in touch with one of the advisors who will manage an account for you.
Okay, great, fantastic. That was my follow-up about the if we knew people, family members that weren't interested in doing this on their own and they needed somebody to do it for them.
Yeah.
And there's pretty strong guarantees that they're going to follow the system accurately. I'm glad to hear that you're confident in them. That's great.
Yeah, I've been working with them for years, and I know they follow the system accurately.
Wonderful. Okay, so changing topics a little bit here. So many people advocate for a risk parity portfolio allocation strategy, the most famous of which might be Bridgewater Associates' all-weather portfolio, which makes heavy use of bonds and commodities. So this has led to the financialization of commodities. Could you talk briefly about what this has done to the correlation of commodities with U.S. equities and what happened to the roll yield?
I have a whole blog post on that you should read. It goes into that in pretty good detail.
Yeah, I read that. That was fantastic.
Thank you. Basically, just to put it in kind of context, I worked with trading advisors, the best ones I could find back in the 1980s. And historically, commodity markets have been used as a hedging vehicle. And then you had speculators who would take the other side. And so there weren't that many speculators. Price would seek an equilibrium, of course, no matter what. In the 1990s, there was some papers out, and some academics said every pension fund should have a portion of their assets in commodities because they don't correlate well with stocks and bonds, and they move somewhat with inflation. So there was this tremendous uptick in the amount of assets on the other side. Also, commodity trading advisors began to attract a lot of attention. So then that interfered with the amount of risk premium going from hedgers to speculators. The same amount of premium had to be spread out over more speculators. And by speculators, I also mean like pension funds. So the returns have gone down considerably since that time. And it's still possible, of course, to make money in any market, but you've got a lot more competition for the same profits. So it's more difficult on the speculation side.
Great. Now, in your book, you recommend using VEU or VXUS. They're both hold emerging markets, but VXUS does include small caps where VEU does not. But early in your presentation, you mentioned how there's not a whole lot of alpha in small caps. Which would you recommend?
Well, there's not a lot of alpha in VXUS, a lot of small cap in VXUS either, because it's cap weighted. So it's really just a minor allocation to small and mid cap there. It's fine, either one. There's a couple of others you could look at, like IXUS and ACWX. They're all pretty much the same. I would tend probably to go with VEU because it's the largest and most liquid.
Great. I understand that you're no longer an advocate for using dual momentum with sector rotation.
That's correct. I put it in my book because, a lot of people were interested in sector rotation, and it is a form of momentum. So why not put it in there? And I had the same data as everyone else going back to the, but then I was able to get additional data on the S&P sectors going back to the early 1970s, and it didn't look so good anymore.
Gary, I think the phone is cutting in and out again. You fixed it before. Is there any chance you can fix it again?
Oh. Well, is it any better now?
Yes, I think it is.
Okay, good. Good. I was saying that I had the same S&P type data going back to the early 1990s when I wrote my book, and sector rotation is a form of momentum, so I put it in there. But when I got additional data back to the early 1970s, it didn't hold up as well. The volatility was higher and the returns weren't as good. So my simple GEM model actually outperformed. So I don't advocate people using it. In addition, there are more moving parts to it. You have to decide how many ETFs you're going to trade, and what criteria you're going to use for switching between them. So I prefer to just keep things simple if you can, and that's the case here.
Okay, I got it. Thank you, Ryan. Those are good questions, and we appreciate the answers. I have a question about futures because I'm really interested in diversification into commodities and futures. And I guess you pretty well wrote a lot of that off in your book to some extent anyway, because you found that they became everything became correlated with everything else when the market went haywire. And so you really couldn't find that much diversification or benefit from diversification in currencies, commodities, et cetera, et cetera. And do you think there's much hope there still, or is that still pretty much more of a dead end?
Well, nobody can say with certainty. I'm happy with just stocks and bonds because you have the highest risk premium from stocks. So you want to be in stocks as much as possible. Nothing has outperformed them historically, over long periods of time. So that's what I want to be in. And then as I showed you in my presentation, a good time to be in bonds is when stocks are weak. So I think they make a really good combination in that you really don't need anything else. People tend, I think, to over-diversify, and they end up with mediocrity when they do that.
No, I understand. Would it maybe make sense? Now, some of your work showed that below 3 month, the market is more mean reverting, or all markets, the markets you looked at are. Would it make sense to both look for momentum trading over the 6 to 12 month time horizon, and simultaneously do mean reversion trading over, say, under 3 months?
Well, I wouldn't say 3 months is the cutoff. Momentum, and it depends on the markets you're looking at too. Like commodities, you can go down to 1 month. Bonds tend to perform better at shorter look backs than 12 months. But for stocks, 6 to 12 months is a good window, if you're looking at stocks. As far as mean reversion trades, I wouldn't say below 3 months. I'd say shorter the better. In fact, I have a mean reversion trading program that I use myself that just gets in and out of various stock sectors in just a few days, 2 or 3 days on average. So I think that's what you need to be looking at if you want to do mean reversion trading. Either go out 3 to 5 years, but you got to have a pretty strong stomach because you can be wrong a long time before you're suddenly right. Or if you're going to do mean reversion trading, you want to be as short as you can, under 1 month certainly, and weekly or daily would be even better.
if you were selling option premium, would you be selling it at a month or less?
Well, you pick up the most time premium that way. You know, the shorter your period is. So that's up to you. You have to balance that out by trading costs and other things too.
Does anyone in the room or anyone on the, I think, do you have a question? No, okay. Does anyone here in the room or anyone on the web, if you type in, we can bring up your audio or pass along the question. If anyone out on the web has a question, could you type and let us know if you, or turn on your mic and just ask it. And does anyone here have a question? Does anyone on the web want to say some things? It'd be good if we could get somebody out there to say a few things.
Anyone want to argue with me? I'm open for it.
So Gary, what are you researching now? Writing any other books?
I will probably write another book on dual momentum, just to answer all the questions I've been asked over the last few years, and to just make the implementation a little clearer. I sometimes get a bunch of emails, you know, people ask some little more detail on implementation. So I do plan to do that. I'm waiting to see if there's an ETF that's coming out for dual momentum. I've been talking to a firm about that. So at the end of the year, there might be, and I would want to wait to see what's happening there before I do that book. The most recent research project I've had is what I've just been talking about. It's mean reversion trading on a short-term basis. I think that's a nice complement to dual momentum. And the idea here is whatever your type of trading you're doing, you want it to be in tune with what the academic research has shown to be the nature of the markets. So if you're going to do trend following of any type, then you want to be in that 3 to 12 month window of look back, because that's where stocks are autocorrelated and where the trends tend to persist. When you get out to 3 to 5 years, they tend to mean revert, and when you get under 1 month, they tend to mean revert. So back in the 1990s, after I semi-retired, I locked myself in a room with TradeStation for a year, and I thought I would come up with a short-term trend-following trading system, and it never worked because I was trying to create something short-term, trending, and the markets are more mean reverting on a short-term basis. So I would get these great-looking models that would never hold up very well. So now I know better, and to do short-term trading, I'm looking at mean reversion.
Hey, Gary. It's my understanding that this is an always in the market strategy. Is that correct?
It's always in stocks or bonds.
Okay. Are you doing anything to manage your risk other than just, I'm assuming this is just a small portion of your portfolio, or is there anything else you're doing for risk management?
Why would this be a small portion of my portfolio? I showed you that you can make over 400 basis points more than being in the S&P 500 index and have less than half the bear market drawdown. So for me, this is a significant portion of my portfolio. And for most of the investors who invested with my proprietary models, it's a core holding as well.
So if you got in long on the S&P at the beginning of the month and it went into some sort of liquidity crisis or crash, at which point you wouldn't be out till the end of the month, you're not doing anything to manage risk?
No, because again, like I said, markets are mean reverting. So chances are if they were short-term weak, that they could very well bounce back. And I'm not concerned about the noise. You know, you have to be willing to accept short-term volatility if you're going to invest in stocks successfully. Those who try to play the very short-term trends and swings usually end up getting chopped up considerably and don't do as well over the long run. I verified that, you know, with my research. I've tried, you know, shorter look backs and different risk management type overlays, and you don't gain anything. You end up with lower returns because you end up getting chopped up a lot.
Thank you.
If we were to look to do some research or test, some of us here do back testing quite extensively, and certainly I want to take what I do. I want to start taking into account some of what I've learned from you. What would you suggest would be a productive area to do some research, maybe in commodities or currencies or any stocks? Or combining options with momentum? What would be any area that you would be interested in seeing some independent research done?
Why would you want to do it? Let me ask you that.
To look for a new advantage. In other words, well, no, you may have a good point there. You're saying that your method is so good that it, I guess, to diversify against the obscure possibility that there might be something else out there.
Well, some people, I think, you know, who diversify just do it on a buy and hold basis. There's nothing wrong with that because, you know, sometimes markets get choppy and whatever you're doing, you know, you're going to get chopped. So if you just want to hold, you know, a portion in U.S. stocks or a portion in bonds, that diversifies away some of your systematic risk, and there's nothing wrong with that. But when you have a program like this, where you can earn 4% more than the market since 1950, you know, there's not a lot more that you can find attractive compared to it.
Okay, that's
as I say,
darn good.
You know, I do diversify a little bit myself, as I mentioned, you know, with mean reversion trading, because it's a whole different ball game. You know, momentum is based on intermediate term trends. It's trend following, autocorrelation, and mean reversion is the opposite. So there really is no correlation there. And it works out really well in terms of diversification. But for other things, I don't know. You know, if some people do it just because they like the action or the activity, or they want to feel like, you know, they've accomplished something. And it's always a good feeling, you know, to beat the market. But I can't really comment on where you should go do that. Maybe you should go to Atlantic City or something, you know, too. I have no idea really.
No, but I mean, like some area that might enhance your own, be along the same lines as your own research, some extension of your own research.
Sure. Yeah, I mean, I've done all of that. I've like I say, I've tried to build models for trend trading back in the 90s, looking at stocks and futures, and there are some people who are successful at it. But I would say just keep in mind what I mentioned. If you're going after trends, then you don't want to be too short term in the amount of look back data you use. And if you're doing mean reversion, you want to be short term. That's with respect to stocks. It works somewhat with other markets, but not so much with stocks and bonds. You have a psychological aspect to them, where they tend to get overextended because people are so familiar with them, and their risk preferences change as the markets move, and those are adaptable to mean reversion trading as well as trend trading.
Well, that's a fantastic presentation. let's have a really nice hand. And I think we greatly appreciate all the time, way beyond the time we necessarily expected that you might be able to be with us. Congratulations on the phenomenal results you have, and we really appreciate your time.
Well, thank you. I've enjoyed it. Anyone has any other questions, feel free to email me. I like to answer emails, and be sure to check out my book on Amazon, look at the reviews and the endorsements, and give it a try.
Thank you. So, by the way, will you be able to give us a copy of the slides? Is that possible?
Yeah, we can do something like that. Just send me an email on it.
I will. I mean, it can be a selection too, Gary. You don't have to send the whole thing, but somebody did ask already, and we always get that question. So that would be fantastic. Thank you again.
You're welcome.
Thanks, Gary.
Good night.
Take care now. Bye.